Hello Maverick traders, this is Imre and welcome to this next video in my wave identification or pattern identification series. Today we're going to be taking a look at complex corrective patterns. I definitely wanted to leave this one for last in the series of pattern identification videos. The reason being is that, well, there's no other way to put this. Complex corrections are in fact complicated and we needed a foundation built first in order to before we can start tackling this subject. So just as a quick recap, the corrective patterns that we've covered to date include the zigzag, the triangle, and the flat. And we need to have covered those three patterns before diving into the complex ones. Okay, so complex corrections, they're called complex because they are a simple correction, such as a zigzag or a flat, that are chained together with another zigzag or a flat, and there could be a triangle thrown in the mix as well. Complex corrections have, again, two shapes, right? Like all corrective sequences do. They either correct through time or through price. So a sharp corrective sequence that is complex in nature would be labeled a double zigzag, and that is this example on the left right here. Okay, so it's a double zigzag because we have the first zigzag, which is labeled using the letter W. Then we have a second zigzag, which is labeled using the letter Y. And connecting those two zigzags is yet another zigzag labeled wave X. So whenever we're dealing with complex corrections where each separate leg of the corrective sequence within a complex correction will be labeled using the letters W, X, Y. And in a very complex scenario, you can use another X and a Z. So it'll be W, X, Y, X, Z. We're going to get into the nitty gritty in just a moment. So don't worry if this looks a little bit confusing, but we're going to move through it in due course. So here on this second example, we have an expanded flat for wave W. We have a zigzag for wave X, and then we have another zigzag for wave Y. And you can see that the entire sequence broadly moves sideways. So if you take nothing else away from this video, right, like if you say, all right, it's too intimidating, I don't want to get into the weeds on how to identify a complex correction, you know, to the T, it's important to note that if you see a sideways correction in a market, it is more likely complex in nature, and complex corrections take a long time to resolve. So a lot of traders get chopped up by complex corrections because they get into the market a little too early. So like I mentioned, there are 3 or 5 alternating corrective patterns that connect, and typically they create a complex sideways motion, but you can have a sharper sequence as well. They consist of the simple corrective pattern, zigzags, flats, and triangles connected by a wave X, which is also a corrective wave, and X waves are also, again, more commonly zigzags. So there are 2 types. The nomenclature I like to use, right? So we have a double 3, which is simply WXY, and then we have a triple 3, which is more complicated, and that is labeled WXYXZ. Complex corrections are difficult to predict, and they're difficult to forecast. In most cases, it is best to wait and let the complex correction complete before thinking of taking a trade. So after a complex correction is completed, I want to see an impulsive movement in the market, a trending move in the market, and then I'm going to trade the ensuing corrective sequence. So it's really a ready, aim, 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 fire approach that I like to take when it comes to complex corrections. So let's cover the double 3. This one is a double zigzag if you're looking at the line diagram on the right-hand side. So it's 2 simple corrective patterns separated by an X wave. Double 3 can have the following combination of corrections. So zigzag in wave W, any corrective sequence for wave X, including a triangle, and then a zigzag in wave Y. So like I said, this is usually referred to as a double zigzag. Double zigzags form when the first zigzag in ABC tends to be very shallow. So remember, this is going back to my zigzag video. Zigzags are price-based corrections, so they tend to be quite steep. So if you have one zigzag that's not very steep, that's when you can start anticipating a potential double zigzag to take shape. All right, so another variation of a double 3 is where we have a flat in wave W, any corrective wave for wave X, and then wave Y is also going to be any corrective wave, whether it's a flat or a zigzag, for example. So here we have some idealized line diagram variations of double 3s. So in the top left-hand corner, we have a zigzag followed by a triangle combination, right? So we have wave W, we have wave X, and we have wave Y. In the upper right-hand corner, we've got another variation where we have a zigzag followed by an X wave, followed by a flat for wave Y. Right, so I'm not going to go over all of these. You can pause the video and take a look. The bottom line that I want you to take away from this slide is that complex corrections tend to take a long time to complete. They tend to move sideways. All right, so if you see a market in the midst of a complex corrective sequence, it is really best to wait it out. Go somewhere else, look for opportunities elsewhere, and then come back to the complex correction once it's completed. So the 333 is very similar to the 33 with one additional wrinkle. Once wave Y is complete, we're going to get another X wave, again more commonly a zigzag, followed by a wave Z, which is again more commonly a zigzag. The 333 is exceedingly rare. You know, in all my time dealing with corrective sequences, I think I've spotted 2 legitimate 333s. They're incredibly rare. I'm showing you this because I need to teach it to be thorough, but you know, I would always say there's almost always a better way to label a price chart rather than looking at a 333 immediately. Okay, so this is a version of a 333 where we have a zigzag in wave W, wave X is a zigzag, wave Y is a flat, and wave X is a zigzag, and wave Z is a triangle. I mean, that is so complicated. But if we wanted to boil it down to its nuts, to the nuts and bolts, so to speak, it is a broad sideways movement. Could be a base. Could be a base in our Maverick language, all right? So if we're looking at our Maverick chart patterns, complex corrections, the ones that move sideways, are typically known as bases. Right, so here's just a closer look at that same pattern. In this case, we have a flat for wave W, zigzag for the first X wave, a zigzag for wave Y, zigzag for the second X wave, and then a triangle for wave Z. So here are some clues to watch out for. So like I said, a double zigzag will typically form when a single zigzag does not retrace to the expected Fibonacci retracement level. So zigzags being steep price corrections, I would expect a zigzag to reach at least a 50% retracement of a trending movement. So in this case on the right, notice how the zigzag doesn't even retrace 38.2%. That would be a very typical clue that we can expect a double zigzag to take place. The typical behavior of a zigzag in terms of Fibonacci retracements is for it to complete at least a 61.8% retracement. That's the most common Fibonacci relationship. I would say really at least 50% is the minimum. Here are some other clues to watch out for. So notice how here in this idealized line diagram on the right, wave 2 took a substantial amount of time to complete, and it was a fairly steep correction. Wave 4 was very shallow. Right? This isn't a hard rule, but typically speaking, I like to see some sort of time-based equality between waves 2 and 4, the 2 corrective waves within a trending sequence. So if wave 2, let's say, took 21 days to complete, right? Pretty much 3 weeks, and wave 4 looks like it's over after only 5 days, you're probably going to expect, you can reasonably anticipate a complex correction to take place to last at least 21 days. Okay, so that's not a hard rule, but it is a very solid guideline to keep in mind. So here's an example of a complex corrective sequence. This one's in the dollar Swiss currency pair. This is a weekly time frame chart. So we can see here, what I want to point out is that wave W ended up being a zigzag. I know it's cut off a little bit to the left, but what I want to really draw your eye to was this complex X wave, multi-year X wave, unfolding as a triangle, all right? And I believe that the triangle is close to completing, which means that we're going to get another ABC sequence to the upside to complete wave Y. So I like to use these corrective sequences at a very high time scale, right? I'm looking at this on a multi-year basis to forecast a larger trending move to the upside over probably several months. It's going to take some time to complete wave Y. But because I have this roadmap in mind, I really don't want to be shorting dollar Swiss unless I'm looking at very short-term time frame opportunities. Now I'm speaking as a swing trader here, right? A lot of my FX trades take several days, if not weeks, to complete. So if I wanted to trade on the lower time frame basis, I'd still keep this larger bullish corrective sequence in mind, and say, look, I'm only looking to really trade to the upside, and I'm going to be very judicious with any short side opportunities on this currency pair. So the final example I'm going to show you, this one's in the dollar Canada currency pair. Again, we're looking at this on a weekly time frame basis, and you can see here wave W was a zigzag, wave X was a flat, and wave Y is also a zigzag. So we have wave A here, wave B of the zigzag took the shape of a running triangle, and you can see that we need one more push higher to complete wave 5 of wave C, of wave Y, of this larger degree B wave. So, it's just, these complex corrections will be messy. They're going to trip you up. It's best to avoid them when you can. I will only trade a complex corrective sequence if there's a very, very, very clear setup to take, all right? So from a practical standpoint, it's best to wait for a strong trending move after the sequence completes, and then wait for the market to pull back and then trade the next trending sequence. So like I said, it's a ready, aim, 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 fire approach, all right? So that wraps up this module on pattern identification, right? We're looking at the core patterns that I've incorporated into my own trading plan. The next step from here is going to be for me to show you how I trade these patterns. All right, so that's where the rubber really meets the road. Thanks everyone. If you have any questions, as always, please feel free to get in touch with me. Thanks. See you soon.